Hello viewers and welcome back to Dukascopy TV. I'm Natalie MacDonald. Joining me next in the studio to discuss emerging markets is Ian McCall of First Geneva Global High Yield Fund. Ian, thank you so much for coming in today.
Thank you, Natalie, for having me.
Now, we know that US gain has really been EM pain very much this year, but how would you respond to comments that the emerging market slowdown is in fact a little bit more structural? Are there reforms that need to be made?
Well, absolutely. There is some real truth to that. There are EM economies where everyone has kind of gotten used to the idea that they were going to be enjoying high single-digit growth in perpetuity, and that's coming to an end in some of the Asian economies. It continues to be the case in Kazakhstan, very strong high single-digit growth, but growth is slowing. Now that said, it's still at a level that compared to developed economies, it's very nice growth. And so this is one of these scenarios where valuations and expectations have changed. But if you're able to step back, the emerging economies still are in a much better situation than developed economies. Better financial situation as far as levels of indebtedness, both at the government level and at the corporate level and individual level. And then additionally, better levels of growth. So it's a situation where that is true, you know, that we're entering into a period where EM growth levels are lower than they have been, but there's still, on a relative basis to developed economies, looking very good. And the positive coming out of this is that some of the economies like Brazil, that were really a darling of the market, you know, the market has seen that in fact growth is slowing, and the high ties between China were great when China was growing, you know, at an off-the-chart kind of rate. As China has slowed, has, you know, really pushed the Brazilians to maybe look at some of the things that they should have been doing all along, but weren't doing because high levels of growth allowed them to sort of, you know, put some things into the back, as is often the case. So it's a bit of a mixed blessing. It's not the end of the emerging market story by any stretch of the imagination. And as some of these economies, you know, as the governments in these economies take steps to correct these deficiencies, and you have overall a better, you know, a better level of growth than you could experience in developed economies, you know, the situation in fact can look quite interesting.
If we consider then the way that money is invested into these markets and where it comes from, would some of these nations be better off perhaps looking to encourage domestic investment opposed to chasing that foreign money then?
Well, absolutely, that's correct. A lot of the economies that have done so well, if you look at Chile, which really took steps 15 years ago to basically sustain and develop a domestic capital base, domestic pension funds, and they consequently have very low spreads on their debt, both government and corporate debt, very high multiples on their equity market. That is really one of the economies where taking steps to encourage the domestic investor base has really worked and done very well for them. It's still the case, though, and thankfully for me as an emerging market investor, that emerging economies in aggregate need to import capital. The domestic capital bases in these countries is not enough to sustain the levels of growth that the different corporates, the different governments want to achieve. And so they require foreign investors. Countries like Russia, where there is regularly a much higher level of capital flight than people would probably expect, given that its growth is slowing, but it's still, you know, achieving a pretty reasonable level of growth. That's a country where clearly, if they could take some steps to stimulate confidence among domestic investors, even though there is already a very big and pretty deep local capital pool, it could be bigger and even deeper. So there's a sort of a mixed scorecard, you know, across the emerging markets. Some have been very successful at stimulating and developing a domestic capital base, but we're still in a situation, you know, where foreign investors are required. Foreign investors have a role to play.
Now, Ian, I know that your concentration obviously is on the fixed income markets. Let's break this discussion down a little bit further. And there's been a lot of discourse of late regarding a divergence between the good EMs and the bad EMs, as it were. In your view, who are the goodies and baddies then, in your view?
Well, there's two sort of sides to the answer. Ultimately, high-level growth economies, clearly that can be a goodie. So a country like Kazakhstan that I'd mentioned earlier, strong growth, and low level of indebtedness. It's developing and accumulating its sovereign wealth fund, at a very solid and consistent rate. But additionally, goodies as far as good economic returns for an investor. And there's often a disconnect, because if the picture, like in Chile up until recently, where commodity prices, which are a big part of the Chilean economy, came under pressure, that was a great economy that was growing strongly, but as a place to make good returns as an investor, wasn't really the place. So there's good economies where something has happened to somehow damage investor appetite for that economy. Those are the kind of places that myself as a dedicated emerging market investor, those are the things that I, on both sides there's a good. But in these baddies and goodies, we're sort of adopting a stock picker mentality to the bond market. And let me give an example in Argentina, where Argentina is another place where their debt restructuring inflicted a lot of pain on a lot of people. A lot of people don't want to hear about Argentina ever again. And basically from March of this year onwards, that's been the strongest performing emerging market on the debt side. And it was one of these scenarios where all the bad news was in and no one owned it. And a few positive things started to happen. And as a dedicated emerging market investor, we're following all these things closely. And we saw some of that. We took some exposures, and that's been a very, very good investment for us. Another situation where there's a bit of a baddie and a goodie mixture is our top performer for this year, and we continue to hold it prospectively in 2014. It's going to do very well for us too, is an Italian telecom company, Wind. It's owned by McCall Friedman via Vimpelcom, and it was bought as a strategic diversification exercise to take some money, out of Russia, and a lot of developed market investors that their job was to look at Italy, their job was to look at the Italian corporate sector, didn't have any understanding of the significance of McCall Friedman, and looked at that, in fact, as a bad thing. Oh, they've got this unknown, foreign owner now. And it was just a complete disconnect, and this is something that has done over 40% for us this year. So it's always good to look at, both the good top-line figures in the economy, but to look at the bad ones as well, to see if some of the companies are in there.
Yeah.
Exactly, or for just a good company in a bad neighborhood. Often this is some of the very interesting situations, that continue to be present right now.
I guess that the big question really, we had this huge summer slump, but you've said already, there are a lot of people, they don't want to hear about Argentina, they don't want to hear about Kazakhstan for the moment. Are you forecasting a 2014 rebound? Are people going to come back round to these ideas, or is it going to be a little bit tricky for a little while?
Well, I think that it's quite interesting, because this is, humans only learn. We'd like to think that we learn by reading, but most of the time we learn by experiencing, unfortunately. And so we've experienced now several U.S. government brinkmanship as far as, the debt ceiling. And the first time that it came that close, markets sold off. The second time, less so. Third time, even less so. It was a non-event this last time as far as asset pricing. So these kinds of situations, like we've experienced this past summer in emerging markets, created some very interesting opportunities. And I think that a lot of this, we were coming up on, for the first time, people on the streets in Brazil. Investors hadn't seen that since, post the military dictatorship in the 70s, a long time. And so that was a shock for people. But when you confront your worst fear and you actually don't die and you survive, the next time you come around to it, you're better prepared. So there's been a lot of shocks, external shocks to the emerging markets, tapering, these situations with, let's just call it societal expectations. Brazilians that want to have a better quality of life. They don't want to pay more for their bus pass because they're feeling squeezed. So they're willing to take to the streets for that. Who would have thought that at the start of the year? But so you get this scenario where we've had a year where we've outperformed. We've been a 93rd percentile performer, but it's simply a case that there's a lot of bad news that emerging markets have had to swim through this past year. The fundamentals are still very good. There's very attractive situations within emerging markets and outside of, as far as the fixed income market goes. High yield, not high grade. So it's pretty interesting to look forward because we may have an interesting year where there's some pretty attractively priced assets. And historically, if you look at emerging market fixed income, it's never had 2 years in a row of negative returns. And for the market this year, it's going to produce a negative return. So not that the past is always a perfect guide to the future, but over 20 years, this has been the situation.
Well, we like an optimistic outlook, and it's incredibly refreshing to hear an optimistic outlook on the emerging markets. Ian, thank you so much for coming in and sharing your insight with us today. Thank you.
You're welcome.
That's all we've got time for right now, but don't go away, as the Dukascopy TV team will be back shortly with another exclusive interview for you. For now, though, it's goodbye from me.